Hi everyone, welcome again to another company analysis video where we analyze the financials of companies with myself, Moeed Amin, and Ted Wayman. So today we're going to be looking at Ocado. Ocado are a British company and they are involved in grocery technology, handling, fulfillment, etc. So they own 50% of, so Ocado Group owns 50% of Ocado.com, and the other 50% is owned by a British retailer, Marks and Spencer, which we incidentally also analyzed, and you can click on the link below or the link in the video, and you'll be able to actually access that analysis. So what do they do? They're basically a grocery fulfillment technology business. So what does that mean? Well, there are a few arms of what they call their Ocado Smart Platform, right? So, shopping channels, so helping grocery businesses kind of connect with the consumers through e-commerce channels like mobile and online shopping, even voice recordings, etc. They even have fulfillment like warehouse and asset handling, and they even do what they call the last mile, which is essentially the delivery part of that, right? So fleet management, they have what they call a proprietary system for them to be able to figure out the most optimal route in order to deliver grocery goods to people's houses. So they're involved in the whole chain. Now, this video was a request from one of our viewers, one of our subscribers. So Goldwing, here is your video, and if you're a subscriber, then you will get instant notification of when we publish your video, particularly if you made a request. So do click on the subscriber channel. So before we analyze the finances, stick around, because what we're also going to look at is the share price. And it's important to note because the share price gives you context in terms of what the financials is also telling you. So what we're going to talk about, so just a quick note on the share price, the 2010 is when it floated. And if you invested back then, you'd be sitting on an increase of about 416%. Not bad. 5 years ago, if you invested, you'd be sitting on a profit of 197%. And if it was a year ago, just like with all well, not all, but most technology companies out there, you'd be down 57%, which is actually not too bad, given the fact that quite a few technology companies are down 80, even 90%. So they seem to have weathered it a bit better than others. One final thing to note before we go into the finances, and this is important, and when you're doing your analysis, these are the things you'll be looking at. They recently acquired a company called Mirmex. Yeah, Mirmex Inc., based in America. And they're a company, they're a robotics business. And essentially they acquired them to help them with warehouse fulfillment, asset handling, etc. So speed and accuracy is the name of the game, which obviously reduces, increases their profitability of handling such goods in their warehouses. So consider that when you're looking at your analysis as well. So without further ado, Ted, let's share with our viewers the analysis on the finances and what story this says about a company like Ocado.
Excellent. Good to see you, Moeed. Thank you very much. So thank you very much. Yes, I'm just going to go back to this comment. So one of the things that we're very keen here on this channel is to improve people's fluency in the language of business finance, your ability to talk finance, whatever role you're in, whether it's sales, marketing, HR, finance, IT, running the business, running a part of the business, or working within the operations. So I just want to pick up on this comment. It says, I worked for them a few years ago and I know they lose money. Okay, now lose money, we have to see, well, what do you mean by losing money? You talk about cash or profit. Cash and profit, not the same thing, as they're still spending lots of their income on reinvestment. Now, if you are making a profit and you reinvest that profit, then you are not necessarily losing money. It depends on, it may be costing you money because you're using money that you're generating or using cash and investing it in assets. So that's what we're going to look at in the cash flow. So the profit and loss account or the income statement will tell me are they making money, and then the cash flow statement and the balance sheet together will tell me are they investing that money and are they generating a sufficient return on that investment. So I think those are some of the questions questions that we're going to try and answer relating to those comments. So without further ado, let's jump in and have a look at their financial statements. So here are the financial statements. They're available on their website. And if you were to visit their website, you would get this lovely, very pretty and very colorful. So you'll notice it's 327 pages. That's down the bottom here, 327 pages. So there's a lot of information in here. And we're going to be looking at the financial statements. And the financial statements are this section here, which are on about 224. So we got to go right the way through. So looking at this kind of this report, you can see what's in there. Lots of information about the company, stuff about the corporate governance, and then the financial statements themselves. So let's whiz down to those financial statements. So here we are. Here are the financial statements of Ocado, and what we've got is you'll notice that for these guys, they give us this kind of results before exceptional items and then exceptional items. Now, I'm always a little bit nervous of that because you'll notice the exceptional items seem to happen on a fairly, they're meant to be kind of like, you know, oh, it didn't happen last year and it won't happen next year. It's a kind of one-off, but they happen on a pretty regular basis. So I tend to just, you know, focus on the total column here. So, and that's what we're going to look at in this analysis. So revenue, we're in millions of pounds here. So revenue is about 2.5 billion. So 2.5 billion up from 2.3 billion. So revenues increased about 7% year on year. Looks pretty good. Cost of sales is about 63% of the sales figure, leaving them with a gross profit, that's this figure here, or a gross margin of about 37%, sorry, which means that for every pound they bill their clients, it's costing them 63p to kind of deliver the service, and they get to keep the other 37p. However, the problem these guys have is here. These are very large costs, and the costs are so big, they are bigger than their profit, and therefore they are trading at a loss. So the operating profit is actually an operating loss. Even before taking into account joint ventures, they are operating at a loss. Okay, so last year it was a profit. Sorry, wrong figure. This figure here, it's a profit. That's a very small profit. That's basically break even. And this year they're operating at a loss. And even if you, after taking into account the finance, the interest that they're paying on their debt, they are, and the bit of tax they're paying, they are operating at a loss. So they are making a loss. So the first answer to Goldwing's question is, are they making money? No, they're not making money. They are losing money. They are operating at a loss. Their costs are greater than their income. So this is a bit of a problem for them because, you know, they do have this debt and they need the banks to carry on funding them. And technically, they can't afford their debt because the debt, they're not making a profit sufficient enough to pay that interest. This is what's known as the interest cover ratio, and is a really important one in terms of the affordability. So good example there, look at the video on Thomas Cook, which is in this series, and you will see a company back in 2010 that couldn't afford its debt. And by 2019, it disappeared in a puff of smoke. So not looking too good. This is not a very healthy profit and loss account. It's loss making, you know, and to a certain extent, there's a kind of like, you know, well, you know, lots of companies as they are starting out, you know, they need to hit scalability. They need to hit that kind of that critical mass in order to start being able to make money. But these guys are, you know, I mean, 2.5 billion is pretty critical to me. It's quite a big mass. So, you know, they haven't got there yet, so to speak. So let's go and have a look at the balance sheet. Balance sheet is down here. Here's the balance sheet. So what have we got on the assets side? We've got property, plant and equipment. That's the biggest part of their non-current assets, or the things that they need to run the business. A little bit of goodwill, suggesting that they've bought some other companies. A bit of other intangibles, which will be a lot of their software development, and some right of use assets as well. Current assets, they've got a little bit of inventory, a little bit of trade receivables. They've got quite a lot of cash. Okay, so they do have a lot of cash, 1.5 billion, a little bit down on the previous year, 1.7 billion. But you know, these guys, they are pretty cash rich, so that's not a bad thing at all. And that means that their liquidity ratio, when you compare their current assets, things which are cash or going to become cash soon, to their current liabilities, things they have to pay soon, you'll notice that they are easily covered. They're very, very liquid. So really, that 1.5 billion of cash easily will pay the 400 million of accounts payable that they have to pay pretty soon. On the non-current liabilities, lots of debt, and we'd expect that again because we saw that they have, remember all that interest that they're paying, and the debt has gone up. So it looks to me like they've been borrowing. They've borrowed an extra 300 million pounds. We'll be able to confirm that in the cash flow. So these guys, yes, they do have cash, but this cash here is kind of they're funding the business by increasing their borrowings. Now, you can do that in the short term, but you can't do that on a sustained basis, because at some point you'll have borrowed too much, and then the banks will say, no, we're not going to lend you anymore, and then your business starts to become tested. So net assets, pretty small. Okay, so the net assets is a reasonably small number. This is and this is the same as the equity. Here it is. The retained earnings, they do have some retained earnings, interesting enough, suggesting that they've made profits in the past, but they're not making profits at the moment, and those retained earnings are going, and therefore this company is very much funded through the investment by the shareholders. So the shareholders have invested 1.4 billion, and they've made, over the past, years, they've made a very, very small profit on that. So no real return on the equity investment there. So there's our balance sheet. So the balance sheet short term looking okay, but long term, it's not looking all that great. It's kind of, I'm just a little bit nervous about this number here. This debt figure just is a bit of an alarm bell for me. In terms of their movement in equity. Now, movement in equity, this is quite an interesting one, because if you look here, so what we're looking at here is the retained earnings, and Moeed, you were talking about the structure of the business earlier, and how they own part of a business, and they own and there's other people who own other bits. So these guys, what you'll notice here, that they made, for example, in the previous year they made a loss, but of that loss, the shareholders of Ocado pick up 135 million, and the non-controlling interest, they actually made a profit. So the bit which they're sharing with the non-controlling interest, they're making a profit, and so there's an even bigger loss for the shareholders. And it's the same with this year as well. So here's the loss that they report for the entire year. There's the loss there. And you'll notice that the non-controlling interests make a small profit, and so the shareholders take a bigger chunk of that loss. So looking at the income statement, the loss that you see there, actually as a shareholder, you're taking an even bigger loss there. So that's something just to be aware of. There's no dividends being paid out, no share buybacks, as we'd expect. So let's go and look at the cash flow statement. So cash flow, this is our number here that we're looking at, net cash flow from operating activities, and it is negative 16 million. Now, that's a problem, because now it was positive last year, and 16 million is only just negative. Don't forget, these guys are turning over, whatever it was, 2.5 billion. So basically, they're kind of cash negative. But cash negative is cash negative. They've got enough cash in the bank. Their burn rate, I kind of calculated as something like 95 years or something. So they're not going to run out of cash just like that. But they do need to start generating cash. And again, we go back to our comment from our viewer, or the person who requested it, Goldwing. So they're losing money, they're burning cash, and they are making investments. So here we can see those investments that they're making, and those investments, they're then obviously trying to generate a return on those investments. But if you do a very kind of rough calculation, EBITDA, return on capital employed, you're generating 3%. And I would suggest that for these guys, the cost of their capital is greater than 3%. We can do a very quick analysis just on the debt, for example, and you can see that the cost of debt is and I'll just look that up on my little spreadsheet. Yeah, cost of debt is about 6%. So if the debt is costing them 6% and the equity is going to cost them more than 6%, because an equity investor wants a higher rate of return than a debt investor because it's riskier for the equity investor. So the WACC, or the weighted average cost of capital, will be much higher than that. And these guys are generating a return on their investment of 3% EBITDA basis, then they're still destroying value. And again, that's kind of reflected in the comment of our viewer. So these guys, they are buying a property, plant and equipment. They are investing. They are not really, they can't afford that. They're not generating any cash to be able to do that. And therefore, in order to be able to do that, they are borrowing money, and there is their increase in borrowings. There's a little bit of refinancing going on there. So the net debt has gone up by about 300 million as they have, and there you go. They were borrowing a significant amount in the previous period as well. So these guys, they've taken a lot of debt. They can't afford that debt. They are refinancing a little bit. They are investing in the future of the business, but they're still nowhere near generating the return on investment that they are promising. But they still got, a reasonable amount of cash in the bank. So, these guys are not in imminent danger of falling over, Moeed. However, they are struggling to kind of, we kind of likened, if you remember, when we talked about Cazoo, we talked about, this pile of investment to try and, like a rocket ship trying to escape the Earth's gravity. These guys, they're in the upper echelons of the kind of the atmosphere, but they haven't escaped. They haven't kind of, they haven't got out of, into a place where they're running a business that's making profit, generating cash, good return on capital employed, ticking along, and it's ticking all the boxes. These guys are not there by any means. And I guess that's probably reflected in the share price. And here is the share price. So, very easy to spot the pandemic. And then the pandemic, everyone goes, wow, everyone's going to be buying online. And of course, if you're an online delivery company like Ocado, and I know it's not an online delivery company, it's a technology company. The alternative to that is my son, who was a key worker at Sainsbury's and was packing, packing bags for online delivery at kind of 3 a.m. Every morning. So people like Ocado, everyone's going, this is it. This is the new world. The share price goes up, and then kind of reality bites. And what you'll see here is that certainly this last bit here is the hammering that Jam Tomorrow stocks have taken. So as interest rates are rising, as we hit this inflation, people are saying, look, actually, I really want to invest in a company that's making profits, paying dividends, and is delivering today, rather than people like Ocado, who are very much promising to deliver tomorrow. So no price to earnings ratio, because there are no earnings. There's no dividend yield, because there is no dividend. In terms of their, any other metrics, they're trading on 2 times sales. I don't know if that's of any meaning at all. 6 billion on a 1.7 billion net asset value on the balance sheet is about just under 4.5 billion of goodwill, which seems quite a lot to me. So, I would suggest that, there is potentially further for this stock to fall. I certainly am not a buyer of Ocado. It's not in my portfolio. It's not screaming buy at me at the moment. If it goes below net asset value, then I might think about it. But this is, if you're buying into this company, you're very much buying into their vision and their strategy, bearing in mind that they haven't delivered on that strategy in the last 10 years. They haven't got there yet. They haven't got to this kind of good, solid business. And will they do that in the next 10 years? Who knows? So this is not for the faint-hearted. Understand their business strategy, buy into that business strategy, and I think that you will find this, an interesting part of your portfolio of investments, Moe. So there you go. Ocado, not for the faint-hearted, certainly not for me. I wouldn't be able to sleep well at night with this stuffed in my portfolio. And if you are looking to buy, if you're looking for the bottom, my opinion, not my advice, my opinion is there might be a little bit further to go for jam tomorrow stocks like Ocado.
Yeah, and on that theme of interesting, thank you, Goldwing, for making this request. It was definitely an interesting set of financials for us to analyze. So love to hear everyone else's thoughts. Do leave your polite notes in the comment section below. And about 98% of the videos that we publish, the companies that we analyze, are actually from requests from our viewers. So if you do have a company that you're really interested in us analyzing for you, do leave a note in the comment section. Leave some context, as Goldwing did, because the more interesting the context, the more likely you'll be bumped up the ladder and the quicker we'll analyze and release the video for your company. So until the next video, thank you, Ted. Thank you, everyone else. Have a safe day.
Good to speak to you, Mary. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.